Ever felt like your business finances are more of a mystery than a well-oiled machine? You're not alone. Many small business owners struggle to keep their books balanced because they don't fully understand the basic building blocks of accounting, debits and credits. But here's the thing, mastering these rules is crucial for your success. Whether you're managing cash flow or preparing financial statements, everything starts here. Master debits and credits, the key to business success. Meet Sarah. She runs a small catering business out of her home. She's passionate about food, but when it comes to managing her books, things get tricky. Like many entrepreneurs, Sarah mixes up her debits and credits. One mistake led her to overestimate her profits, resulting in a massive tax bill she wasn't prepared for. A simple misunderstanding of these basic accounting concepts had a big impact. Scene shifts to Sarah speaking confidently after learning the basics of debits and credits. But once Sarah learned how to use debits and credits properly, her business finances became much clearer. No more surprises at tax time, and she felt empowered to make smarter decisions. Now, imagine applying that same clarity to your own business. Ready to find out how? Welcome to Education Bench, the go-to channel for mastering essential accounting and finance concepts. Whether you're a student prepping for exams, a professional refining your skills, or a small business owner like Sarah, our mission is to break down complex topics into simple, actionable lessons. Let's dive in. So what exactly are debits and credits? In the world of accounting, they are the foundation of how transactions are recorded. Every transaction impacts two accounts. One is debited, and the other is credited. This system, called double-entry accounting, ensures that your financial statements are always balanced. For example, if Sarah buys $500 worth of catering supplies, she'd debit her supplies account because she's gaining an asset and credit her cash account because she's spending money. Seems simple enough, right? But here's where things get confusing. Debits don't always mean an increase, and credits don't always mean a decrease. Understanding when to use debits and credits can be tricky, but don't worry, we'll break it down step by step. Let's explore the rules. There are 5 main categories in accounting: assets, liabilities, equity, revenue, and expenses. Each of these categories has its own rules for debits and credits. Assets: increase with a debit, decrease with a credit. Liabilities: decrease with a debit, increase with a credit. Equity: decrease with a debit, increase with a credit. Revenue: decrease with a debit, increase with a credit. Expenses: increase with a debit, decrease with a credit. Let's take Sarah's business as an example again. She needs to record a sale of $1,000. Here's what happens in accounting terms. She'll debit cash for $1,000 because her cash is increasing, and she'll credit revenue for $1,000 because her income is also increasing. It's important to remember that the rules for debits and credits vary depending on the type of account. Now, what about if she pays rent for her kitchen space? That's an expense. She'll debit the rent expense account because expenses increase with a debit, and credit her cash account because she's paying out money. So, how do you apply this knowledge in your day-to-day business? One tip is to use accounting software that automatically applies debit and credit rules for you. But even with software, understanding how these transactions work is crucial to catching errors and ensuring your financials are accurate. Keep a reference chart of debit-credit rules nearby. Review your accounts regularly to make sure everything balances. Use the trial balance function in your accounting software to verify accuracy. Regularly reviewing your financial statements and understanding how transactions impact your accounts will prevent costly errors. Many people ask, what happens if my debits and credits don't balance? Well, that's where the trial balance comes in. A trial balance is a report that lists all the accounts and their balances. If your debits don't match your credits, it means there's an error in your entries. Most software programs will help you find where the mistake is. Another common question, does a debit always mean I'm gaining money? Not necessarily. Remember, it depends on the type of account. For an expense, a debit means an increase in cost, not cash. Now, for those of you who want to go a little deeper, did you know that larger businesses often deal with contra accounts? These are accounts that offset others. For instance, a contra asset account like accumulated depreciation, is credited when you record depreciation expenses. These advanced concepts are critical for those managing more complex financial operations. Let's recap. Debits and credits form the foundation of accounting. By understanding which accounts are affected by each, you can keep your books balanced, avoid financial surprises, and run your business more efficiently. Whether you're a student, a business owner, or a finance professional, mastering these basics is essential. If you found this video helpful and want to keep sharpening your accounting and finance skills, hit that subscribe button. At the Education Bench, we're committed to simplifying complex financial concepts for students, professionals, and everyone in between.